Welcome traders and investors to this informative presentation on effectively utilizing the supply and demand system on MT5. I'm Joeli. With over a decade of trading experience, I have created this system to enhance your trading strategy, maintain consistency, and improve your profit margin. The concept of supply and demand has been a fundamental principle in economic theories for centuries. Visionaries like Adam Smith and David Ricardo recognized its significance in market dynamics. Adam Smith, often regarded as the father of modern economics, discussed the invisible hand and the equilibrium achieved through the interaction of supply and demand. David Ricardo further developed this concept in his theory of comparative advantage. However, the principles of supply and demand have been observed long before these renowned economists. The interaction between supply and demand has been an essential aspect of human trade and commerce throughout history. Today, it remains a cornerstone of economic theory and finds widespread application in various fields, including the financial market. Now, let's delve into the supply and demand system and explore its two versions available on MT5, the supply and demand tracker and the supply and demand edge. While both serve the same purpose, the supply and demand edge incorporates additional inputs such as the moving average convergence-divergence (MACD) crossover signal. The supply and demand system employs a look-back function to calculate a range of data points based on historical data. Considering the current market conditions, the system can project accurate future supply and demand zones. The algorithm assigns greater weight to recent price actions to ensure the system is always up to date. The supply and demand tracker is a standalone tool that utilizes pure price action. It automatically projects supply and demand zones ahead of the price action, providing a clear price structure. Additionally, it allows users to integrate their preferred indicators to identify market trends, potential entry and exit points, and ultimately stay ahead of the price action. On the other hand, the supply and demand edge goes a step further by incorporating the MACD crossover signal. Traders can combine this signal with other indicators like moving averages and momentum indicators to identify market trends and potential entry and exit points to stay ahead of the price action. Now, let's explore the combination between the supply and demand system and the Fibonacci retracement tool, which proves invaluable across all time frames. This tool, always aligned with the supply and demand system, helps gauge the market's future direction during pullbacks. To illustrate, let's consider a 4-hour chart demonstration featuring the gold, US dollar. Applying the Fibonacci retracement from the recent lows to the highs allows us to determine the pullback's extent and identify potential bounce-back areas. The Fibonacci sequence, including levels 23.6, 38.2, 50, 61.8, 78.6, and 88.6, aligns with the supply and demand system, serving as the primary price structure for your analysis. For instance, the 23.6 Fibonacci level, aligned with the demand zone, becomes pivotal in determining whether a pullback or continuation of the trend will occur. Supplementing your analysis with moving averages like the 62 and 162 exponential moving averages offers additional confirmation of the trend's direction. A drop below the demand zone, the 23.6 Fibonacci level, and the 162 exponential moving average strongly indicate a potential trend reversal. These levels are dominated by major players and can be volatile. As the price continues to trade below the 162 exponential moving average, it suggests a bearish trend. The 38.2 and 50 Fibonacci levels often create significant volatility as bulls attempt to regain control. Observing the price's behavior in relation to these levels while considering the 162 exponential moving average provides valuable insights into market trends. The 61.8 and 78.6 Fibonacci levels are critical points where normal pullbacks typically bounce off, particularly the 61.8 Fibonacci level. Confirming the reversal to the upside requires the price to break the 162 moving average and hold. Supplementary tools such as price channels and trend lines can further validate the breakout and trend reversal. To identify potential reversal points to the upside, we first plotted the Fibonacci retracement from the bottom of the trend to the top. In this example, the price dropped to the 50 Fib level and bounced twice, returning to the 38.2 Fib level. This was an indication price could reverse, but we need more confirmation. To explore further, we implement a different strategy using the same combinations to determine if prices will reverse to the upside. This time, we plot the Fibonacci retracement from the highest point to the 50 Fibonacci level, the lowest trend level, generating a new Fibonacci sequence. The supply zone aligned with the 23.6 Fibonacci level becomes the reference point for determining whether the price will bounce off and reverse. For a confirmed trend reversal, the price must hold at this level. The breakout at the 62 and 162 moving averages further confirms the reversal of the trend. The supply and demand zones aligned with the 38.2, 61.8, and 78.6 Fibonacci levels become potential target areas. The 62 and 162 moving averages also serve as valuable guides for long-term trading strategies. It is important to note the significance of the 161.8 Fibonacci golden ratio level, often used to identify major trend reversal points. In recent events, we witnessed gold reaching its highs near the 161.8 Fibonacci golden ratio level before descending and reversing to the downside. By combining the supply and demand trading system with the Fibonacci retracement tool, you gain access to one of the best tools available for retail traders. It is built on the core principles of supply and demand and price action. This system provides valuable insights into future price movements. Incorporating the supply and demand system into your trading strategy can transform your approach to the market and potentially increase your profit margin. The supply and demand system and Fibonacci combination can be applied to various assets and different time frames, including Forex, the stock market, indices, commodities, cryptocurrencies, ETFs, futures market, etc. For those just starting, this system offers an excellent opportunity to adopt the right trading concepts from the beginning. It accelerates your learning experience and sets you on the right path. If you're still exploring your trading journey, I highly recommend the combination of the supply and demand system with Fibonacci retracement. You can further explore this system by incorporating your favorite indicators or exploring a variety of momentum indicators such as Bollinger Bands, MACD, RSI, stochastic, moving averages, and more. To acquire your discounted copy of the supply and demand system, please visit the following link or leave a comment and I will get back to you.